Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
That's sort of the next thought process is how about buying uncertainty? You can buy volatility. So buying volatility, I could buy straddles, the 120, 118. I could be buying strangles, which is sort of that 118, 112, 114, any of these puts with any of these calls. Or if I thought the market was going to stay in a range, I could actually do the opposite and sell some of this. I could maybe sell the 116, 112 put spread and maybe sell the 124, 120 call spread. Hope that it stays in the range and you'd earn the premiums. There are so many choices, whether you're very bearish, bearish, neutral, moderately bullish, or very bullish. This could be sort of your guide to how you trade options. Again, it's not appropriate for me to tell you, oh, you should only be buying puts or calls or strangles or straddles or selling spreads or buying spreads. Once you learn more about options, I think you'll find the strategies that you're most comfortable with. So to summarize what I just spent the last 50 minutes on, options allow investors many choices for their portfolio. So what's going to happen in 2009? None of us really know for sure, but if you have a long-term view, let's just say that you think at some point the dollar is going to do this or that, maybe you can wait for the market to sort of move in your direction, and then it gives you maybe a better risk-reward. Investors use options for limited risk, for hedging, and to create unique trade-offs. Currency trading has become a lot more popular in recent years, and again, we have tremendous integrity at the ISE since we're regulated by the SEC. And these options trade directly through your equity options broker. Options are based on probabilities, so you want to keep in mind risk-reward. Also, you want to think about diversifying your portfolio, so please remember, you want to think about correlations, but also these correlations can change. Never trade beyond your risk tolerances. Please consider the implication of all your positions prior to entering any positions. Would love for you to go to, we think that we've done a great job, and of course we're still always trying to add more information to the ISE site, www.ise.com/FX. You'll see where we have an FX options weekly outlook every Monday morning. You can get a perspective on what's going on the previous week. Jason Ayers will come on, and you can actually download this right to your iPod or your computer. We have FX options trade alerts. You can sign up. Trading Central, a group out of Europe, offers their own trading views. You can sign up for those free for a limited period of time. We have webinars. You're all participating in that. I personally write a lot of articles, so you could read alternative strategies for multi-asset class trading, FX option alternatives for spot traders. I wrote an article, The Credit Crisis, Other Options for Investors. So I, from time to time, write these articles. They're always free. And again, the ISE FX options widget, I think it's just wonderful that you can know what's going on in all 6 pairs. We also have an options calculator. You can go to the ISE site and download this. So at this point, I want to thank you all for coming to our first webinar in 2009. We'll be doing many, many more. You can sign up, of course, at the ISE, www.ise.com/FX, for webinars, archives, podcasts. They're all available. So at this point, I'm going to try to answer your questions. And again, I want to say thank you, and let's have a great 2009. Question about reviewing the slides. If you go to www.ise.com/podcast, you'll be able to get all these slides. So, you can view them again and again. So many questions. I hope I can try to answer as many as I can. Mark wants to know, should I think of all options as U.S. dollar based? Yes. So think of it this way. I'm in New York City, and I'm going to Toronto or Vancouver. What is that dollar worth when I get off the plane in Toronto or Vancouver? You could trade options based on that view. So we know when we go from New York to Toronto, last year at one point, the dollar was actually below the Canadian dollar, but we're trading as the dollar relative. So if you thought the dollar was going to rally, which of course it did, from let's say parity up to about 130, you'd have been buying call options. Now that it's trading at 118 or so, what's your view? If you're bullish, you'd be buying calls. If you're bearish, if you think it's going back to parity, if you think, let's say, the economy is going to be okay and that maybe the crude's going to move back up again, maybe you'd be buying put options. So I hope that helps, Mark. Let's see. I want to answer definitely many more questions here. Go back to that previous slide. Okay. Stephen wants to know about leverage in FX options. That's a great question, Stephen. Really, leverage is created by the strike price that you select. So I always get this question, how much leverage should I use? This is much different than looking at the spot world where investors sometimes use 20, 30, 40, 100 to 1. And they end up, a lot of them get wiped out because they just use an inappropriate amount of leverage. Well, in the options world, when you buy an option, you have to pay for it the next day. If you buy a lot of out-of-the-money options, you're getting a lot of leverage, but you also you're going to hold a lot of time premium risk. So I think you sort of understand that even. It's just much more straightforward. So you buy out-of-the-money options, you have more leverage. If you buy in-the-money options, you have less leverage, but you have more dollar risk. And, of course, that's how leverage works, double-edged sword. So I hope that helps, Stephen. Roy wants to know, when charting FX technicals, is there a difference in FX pair quoting and to FX options quoting? Remember that we're quoting dollar relative. Other than that, no. The option prices are going to be based on, you see on slide 71, EUI, YUK, BPX, SFC, CDD, and AUX. The options are going to be based on what that pair value is, and you'll be able to get those price trends, those charts, through your broker, or you can get them at the ISE. And there's another great place called livevol.com, live, L-I-V-E.com, livevol.com, and you'll be able to type in, as long as you know the symbols, EUI, BPX, YUK, SFC, CDD, and AUX, you'll be able to see sort of the trends there.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.